The problems for my videos can be downloaded from my website, tonybell.com. Go to the website, click the PDF link. You'll see there's no sign in, no sign up, nothing like that. Just 100+ pages of accounting exercises. Many of the exercises are free and open, about 40%. And if you're working through those and finding you're getting great value out of them, you might consider joining and getting a channel membership that has access to the other 60% of the videos. All right, let's jump into today's exercise. Let's examine problem 2.5b, journal entries of job order costing. Two wonderful topics in one, hopefully wonderful problem. You can download it, tonybell.com, click the PDF link. No sign-ins, no logins, no nothing. Let's go. Ace Cakes makes cakes and desserts for all festive occasions. The company uses a job order costing system to allocate manufacturing overhead costs to jobs on the basis of direct labor cost. Again, many of our questions, we've done this on the basis of direct labor hours. This one is based on direct labor cost. What is that saying? It's saying our predetermined overhead rate estimated total overhead divided by the estimated driver of overhead. In this case, it's the estimated direct labor cost. And it further says the company anticipates its overhead costs for the upcoming year are going to be $150,000. And its direct labor costs, it expects to see direct labor costs of $500,000. So 150 divided by 500 gives us 0.3. What does that number even mean? It means for every dollar I spend on labor, I expect to spend 30 cents on overhead. Another way of putting it, if I do a job, I make some big batch of cupcakes or a beautiful cake, I guess, for a customer, and it costs me $100 in labor, I add $30 as my guess for overhead, because I don't know the overhead in the minute. I don't have my property tax bills. I don't have my utilities bills for the month. There's a lot of things I don't know. So I estimate when I do a job, if it costs me $100 in labor, it's going to cost an additional $30 in overhead. That's what this is telling us. For every dollar I spend on labor, I expect to spend $0.3, 30 cents, on overhead. That's what that means. The following costs were incurred, or events rather, occurred during the year, and there's A through K, and it says, first, we're going to do journal entries for A through K. So let's get going and do journal entries for all of those items. If you're shaky on journal entries, search my name, Tony Bell, Journal Entry Bootcamp. I think it'll be helpful to you, but let's jump into it. Purchase $250,000 of raw materials, eggs, flour, sugar, that's the raw material of a bakery, on account. Okay, so we bought raw materials. Raw materials are an asset. We're going to debit raw materials inventory, $250,000. And we're going to credit if we bought them on account, and it didn't say here, unless otherwise noted, assume all transactions are on account. We're going to credit then accounts payable. If we had paid cash, we of course would credit cash, but here we're assuming everything's on account. Let's move on to B. Purchased $11,000 of cleaning supplies on account. Debit cleaning supplies, which is almost like a type of inventory, and we credit AP, credit accounts payable, for $11,000. Cleaning supplies are an asset until we use them up. Okay, on to C, and this is where things start to get interesting. Requisition, $240,000 of direct materials, so eggs, flour, and sugar, and $10,000 of supplies for use in production. Okay, let me take a big step back here. The question is a good question. I wrote it, but the question I think is a good question. However, something confusing about this question is the company is not buying $250,000 of eggs, flour, sugar in one transaction. They're doing it a couple times a week, a couple $1,000s at a time, right? They're not going to Costco and walking out with $200,000 worth of stuff. They're going to Costco twice a week and walking out with $1,000 and $2,000 worth of stuff. Still a lot, but not hundreds of thousands of dollars. This is a summary of what's happened. So Requisition $240,000 worth of direct materials means we took the $240,000 out of our fridge and we started making cakes, right? We took $240,000 worth of eggs out of the fridge. We started making eggs. Again, making cake. We do this $1,000 or $2,000 at a time, as we make cakes in batches of cupcakes or whatever it is that we are making. Fancy cakes for weddings, maybe. Okay, so what does that look like? Well, what we're saying is when it's sitting in the storage, in a refrigerator or a pantry, we call it a raw material. When we bring it into the kitchen, we start making a batter out of it. We start making cakes out of it. It becomes work in process. So when you requisition it, you're saying it's no longer a raw material. I'm starting to work on it now. It's work in process. We debit WIP inventory here for $240,000, and we credit raw materials inventory for $240,000. But wait, you say, what about the second part of the sentence? We not only requisitioned $240,000 of material, we also requisitioned $10,000 worth of supplies, cleaning supplies. What does that look like? Well, cleaning supplies don't go into the cakes, and therefore they are not a direct material in the cake. The eggs, flour, and sugar, that goes into WIP. Cleaning supplies goes into MOH. They're an indirect factory cost. They are a manufacturing overhead cost. We abbreviate that as MOH. So debit MOH 10,000, and now they're no longer unused cleaning supplies. That asset has been used up. So we credit cleaning supplies to say, I don't have as much Mr. Clean or Windex or whatever it is I used. I've used those up. So credit cleaning supplies. On to D. Incurred employee costs, direct labor, indirect labor, admin salaries, salespeople's wages. All right, direct costs go into work in process. So direct material went into WIP, direct labor cost goes into WIP inventory. Again, the pastry chef who has their hands on the product while they're working on the product, we debit WIP $450. Now, again, in no single day does somebody get paid $450,000. This is all of my chefs for all of the year, and I would charge it every 2 weeks. Essentially, I'm paying them, so it just looks unusual. The number's so big. These are summary journal entries. For II, indirect labor. So this is the cost of their wages while they're cleaning or setting up. They're not actually making cakes. They're doing other stuff. That's indirect labor. That's overhead. Those are still kitchen costs. Those are still factory costs. The factory of our cake company is a kitchen, but, these are still cost of the production area, and we call that overhead. Admin salaries, those are office costs. Those are outside of the production area. Therefore, it's not material, it's not labor, it's not overhead. These get expensed. So debit admin salaries expense for $200,000. Sales wages, same thing, didn't happen in the factory, therefore we just debit the expense related to the item, $80,000 in this case. Let's total these up. 450 plus 50 plus 280, it's 780 in total. Oops, I did that funny. I don't want to draw a line underneath. We credit though, we didn't pay it, right? Assume this is on account. And so if these are on account, then it's salaries and wages payable. Now, don't get me wrong. We definitely would pay this every 2 weeks, but just for this journal entry purpose, credit salaries and wages payable, or wages and salaries payable, 780. Okay, let me move this stuff up because I want to continue to work here beside the question. So I'm just going to move those up to the top and we will keep going. So we've just done D. We're on to E, advertising. Advertising is 3,000. So on E, what is advertising? Is it material, labor, overhead? No, it's outside of the factory. Therefore, we just debit the expense or debit the appropriate account related to advertising, and it's advertising expense. It's a selling cost, of course. $3,000. Now, normally I would think credit cash, but it's on account, so credit AP for $3,000. On to F. Property taxes. Okay, property taxes, $10,000. 90% of the space is kitchen space, so 90% of our property tax applies to the kitchen. That's $9,000 in kitchen cost. Is it material? No. Is it labor? No. It's got to be over. Then it's indirect kitchen cost. $9,000. And what about the rest of it? Well, the 10% is office cost. You debit sales office, I guess. You don't debit sales office expense or admin expense or selling expense. You debit property tax expense. That's something that students do get wrong from time to time. Property tax expense, $1,000. The credit here is to, I would expect, probably accounts payable, $10,000. Some people might say prop tax payable. I think that's okay. I would expect I would treat this as a normal account payable in my list of payables if I were the company. But prop tax payable is totally fine there too, in my opinion. G, and you're watching my video, so obviously you care about my opinion. Depreciation, $55,000, 80% kitchen, 20% office. Okay, well, let's deal with the kitchen first. It's depreciation. Is this direct material? No. Is it direct labor? But it happened in the kitchen. It's got to be overhead. So 55,000 times 0.8, 44,000 of overhead. Debit MOH, 44,000. The other 11,000 was office. So we don't debit office expense. We debit depreciation expense. 11,000. The credit here is funny, and you have to remember your intro accounting class. You don't credit depreciation payable or something like this. You credit accumulated depreciation. That's the credit that goes with depreciation, and you just have to remember it. If you don't remember it, you're gonna screw it up. Credit accumulated depreciation. That is so messy. I'm gonna fix that. Ugh. If you ever notice I write neat in some things and messy in some, it's because I zoom in really close and I make extra sure. So let's make extra sure on this one. Depreciation. I'm running out of space. There we go. That looks much better. Okay, accumulated depreciation. That's G. On to H. Insurance expired. $15,000. 80% kitchen, 20% office. So we're getting into this habit of going, well, it's in the kitchen, but it's not material, it's not labor, it's got to be overhead, and that's the case here. 80% of 15,000. I can't do the math in my head. Yes, I can. 12,000. Debit MOH 12. The other 3, we just debit the expense related to insurance expense. The other 3 was office equipment. We had insured some office equipment. Anyway, there you go. $3,000 insurance expense. The credit related to insurance that's expiring is not accounts payable. It didn't say we bought new insurance. It said insurance expired. And if you think back to your intro class, insurance expiring is a prepaid expense that is expiring. You credit the prepaid asset. You credit prepaid insurance. If you're shaky on journal entries, generally search up my name and Journal Entry Bootcamp. If you're shaky on this concept of prepaid insurance, search up my name and adjusting journal entries. We go over that concept, but you can just get there by practicing along with our management accounting. But that's a financial accounting concept that you might have forgotten. I would forgive you if you had forgotten it from all those months ago when you were in your financial accounting class. Manufacturing overhead costs were applied to production. This is the $1 million moment here. Now, in reality, every time we make a cake, we just go, what was my labor cost in the cake? Add 30 cents an hour for overhead, or add 30 cents a dollar. So if I spent $100 on labor, add $30 for overhead. That's the overhead charge. Now they're saying, well, what's the overall overhead charges that I added, across all of the cakes I made? And the answer is, well, what's my overall labor cost? $450. And what we had said was our predetermined overhead rate said, for every dollar I spend on labor, I expect to send 30%, 30 cents on overhead. So I spent 450 grand on labor, I expect to spend 30 cents, 30% on overhead. So 450 times 0.3, I expect my overhead cost, if I did 450 grand of labor, my overhead cost would be 135. This journal entry, I got a cough, had like a tickle in my throat. This journal entry is like the key entry. It's saying how much estimated cost are we putting into our jobs? In other words, when I'm estimating the cost of my jobs, how much overhead goes into it? Because I can use the actual labor, I can use the actual material in the moment. I have to estimate the overhead, and I've said the total estimated overhead here is 135. When I put the material into the job, debit whip. When I put the labor into the job, debit whip. When I put overhead into the job, guess what? Debit whip. 135. The credit here is to MOH, and that's just one you're going to have to remember. You're going to have to remember. You're going to be doing this. If you do journal entries in job order costing, you will do that journal entry for sure, for sure, for sure. On to Jay. Jay says, desserts costing $7.90 were completed. This is saying they're not WIP anymore, right? We were not sitting there with hundreds and hundreds of thousands of dollars of cake batter uncooked and going rotten. No, we cooked the cake. We finished the goods. So it's no longer WIP. It is a finished goods inventory. So debit finished goods inventory. The total value is $7.90. Again, we did not make a single $790,000 cake or have a single $790,000 wedding. We had hundreds of weddings, each of which we charged a few $1,000s. These are obviously fancy cakes, I suppose. $790,000 of finished goods inventory. Credit WIP inventory. $790. Okay. That's the finished goods inventory entry. On to the last one, on to K. K says the company had sales on account of $1.8 million. That is a big cake company. $1.8 million of sales. All right, first we can just stop there. There's a journal entry to be done. We had sales on account. If we had sales for cash, debit cash. We had sales on account, debit AR. $1.8 million. And we credit sales rev. This is us doing what we do to earn money. We're selling cakes and lots of them. $1.8 million. According to cost data, the jobs cost $720,000. The cost of the cakes that we sold, our cost of goods sold was $720. And what do we credit? Well, whenever I debit COGS, I credit inventory typically. And in this case, we got to be specific. We didn't credit raw materials. I didn't sell eggs and milk and sugar. I sold finished goods. So we credit finished goods inventory. That's the type of inventory we sell. We're only really in the business of selling finished goods here. Okay, so we've done part A. We've done journal entries A through K. Let's move on and figure out if overhead was over-applied or under-applied. To do it, you just make a big T for overhead. So let's make a big T for overhead and see where we're at. And we just go through all of our journal entries looking for MOH. Let me see how this goes. Is this too big? Oh, that's perfect. I picked the perfect size highlighter. I'm on today. So anytime I have MOH, I'm just going to highlight it. There's MOH there. There's MOH there. Overhead there. There. And there. I think that's all of my overheads. Let's put these all into the T account and kind of discuss what we see. So I got a debit of 10, a debit of 50, a debit of 9, a debit of 44, a debit of 12, and a credit of 135. I think I've got them all. 1, 2, 3, 4, 5 debits, 1 credit. Yeah, that's looks like I got them all. Okay, so this is what my T account looks like. And let's remember what's happening. On the left side, these were actual overhead costs that came in over the course of the year. And again, they drip in a bit at a time. These are big numbers that are summaries of like things that would have happened on a weekly or monthly basis. This one is my applied overhead, and this would have been in hundreds of pieces with every little job I do. I apply a little bit more overhead, a little bit more overhead. This question summarizes things. So my overall overhead that I guessed was 135. My actual overhead, though, was a different number. 10 plus 50 plus 9 plus 44 plus 12. Okay, there you go. My actual overhead was 125. My applied overhead was 135. I applied $10,000 too much overhead, right? My guess on overhead was $10,000 off. Now, that's not terrible, but it's off. So if I look at this T account, I just take the big side minus the small side, I end up with a credit of $10,000 in my MOH account. And we always comment on overhead being over-applied or under-applied. Well, what do you think the case is here? I applied 135. I actually had 125. A perfect applied would have been 125. I over-applied. I applied too much, right? So this is $10,000 of over-applied overhead. So that's the answer to the question. Was overhead over-applied or under-applied for the period? By how much? As $10,000 over-applied. C says, record a journal entry to close overhead to cost of goods sold. In my questions, we're always going to close it to cost of goods sold. You will see some questions that say, we're going to close some percentage of this to WIP and some to finished goods and some to cost of goods sold. In my questions, we're just going to close to cost of goods sold. I think it's simpler. So what does that look like? Well, it just means make this account zero. Make this MOH account go to zero. How do I make it go to zero? I'm going to debit MOH and I'm going to close it to cost of goods sold. Let's sort of think about, well, let's do it and then we'll sort of think about why. So I'm going to make this an L journal entry. That's an L. It doesn't look like an L. There's an L. It's an L journal entry. There wasn't really an L entry. I'm just making it up. I'm closing MOH to cost of goods sold. So I debit MOH 10,000. And I credit cost of goods sold 10,000. Now, what is actually happening here? During the year, I estimated my overhead cost was 135 based on these, transactions that happened. I was off by 10 grand. I charged too much overhead to my jobs, just one little job at a time. $10,000 overall, too much overhead was charged to my jobs. In other words, I thought my jobs cost $10,000 more overall than they really cost. So if I want to fix this, well, remember, I've sold most of those things. I've charged cost of goods sold based on having too much overhead. I've charged cost of goods sold $10,000 too much. How do I fix it? Well, I reduce my cost of goods sold in a journal entry. I debit MOH to make it zero. I credit cost of goods sold to reduce it to its more accurate number. And there we have it. We've fixed our cost of goods sold. So it said record a journal entry to close overhead to cost of goods sold. Done. Final step. And this is a long step, based on the information above, prepare an income statement for the company, assume a 20% tax rate, and assume a year end of December 31st. Okay, let's do it. Start with the name of the company, Ace Cakes. Ace Cakes. Next line down, income statement. Income statements get dated for the month ended, or in this case, for the year ended. Could be for the quarter ended too, but they told us for the year ended December 31st. We could even give a year if we knew the year. Okay, income statements start with sales rev at the top. Well, whatever revenue we have sales revenue, $1.8 million. Next line down, cost of goods sold. Our cost of goods sold, we thought it was $720, but we just said, no, we overstated it by 10 because I over-applied overhead. It is really $720 debit minus a $10,000 credit is really $710. Now, interestingly, we over-applied our overhead. Had we under-applied the overhead, we would have gone debit COGS and credit MOH, and we would have had to add to our COGS total. Here we're deducting $720 minus 10. Under different circumstances, under-applied overhead, you would be adding your cost of goods sold adjustment there. $720 minus 10, though, is $710. That's our cost of goods sold. what is this? 1090 is our gross profit. I'm going to double check that number just to make sure I got it right. I feel pretty good about it, but sometimes I make silly mistakes. 1800 minus 710. It is 1090. That's good news. Then we go on to just our expenses, our selling and admin expenses. And I'm going to have to just dig through my journal entries looking for expenses. So let me grab a yellow highlighter and we will go fishing for some expenses here. No expenses, no expenses, no expenses. Here we go. Admin salaries expense, sales wages expense, advertising expense. Notice they're all debits. Property tax expense, depreciation expense, insurance expense. That's it. Okay, so I've got my expenses. Now I just have to list them all out, total them up, and we'll be almost done here. Admin salaries expense, sales wages expense. I lied. I said when I zoom in, I write a lot neater. Well, it's not that much neater. It's not that much. It's not that bad, though. 280. I've done worse. 200,000. Sometimes I look back at some of my questions. I go, what was I even writing? It makes sense when I listen to the audio and I'm explaining it, but sometimes you look back, it's hard to tell. Advertising expense, property tax expense. I'm doing them two at a time here just to save me from scrolling up and down. Advertising expense, and I think it was property tax expense. I forgot the amount, so let's go up. 3 and 1. Now our property taxes were much higher than that, but because it was on the kitchen, we said, oh, that's part of the cost of making the cakes, and therefore it becomes part of the cost of the cakes, and it's buried in cost of goods sold is where that expense or that other 9,000 is. Depreciation expense and insurance expense, those are our last two. I think it was 11,000 and I forget what insurance expense was, so I'll go back up and check. 11,000 and 3,000. Okay, so that's it. 1, 2, 3, 4, 5, 6. Yeah, that's how many I thought I would have. Our total selling and admin expenses are 200 plus 80 plus 3 plus 1 plus 11 plus 3, $298,000. We have a very profitable bakery. This is an unrealistically profitable bakery, insanely profitable bakery, in fact, but there you go. So our income before tax, $1,090 minus $298 is $792, $792,000. We've got an income tax expense, which we said was 20%, I believe, unless I've forgotten. Yeah, it said assume a 20% tax rate, so 20% of our pre-tax profit here, 792 times 0.2, 158,400. That brings us down to our profit, our net income here, which is 792 minus 158,400, 633,600. Double underline at the bottom, dollar sign at the top of each of my two columns, dollar sign beside anything double underlined, and there we have a beautiful income statement. I'm just going to scroll through everything as you're reaching for that thumbs up button. There's our income statement. We've calculated whether overhead was over applied or under applied. It was over applied by 1,000, and we did all of these beautiful journal entries. What a problem. That was a long one, 28 minutes and 40 seconds according to my clock. If you made it to the end, for goodness sake, smash one of those buttons. Let me know you made it. I always wonder if anybody makes it to the end. Thank you for watching. I'm so happy you're here, and I'll see you in the next video. Bye for now. The next video in our series is right up here, and if you want a supercut of all of the videos in this series, that's the one down below.